2023 was the slowest year in the housing market in nearly 30 years. That means realtors made less money. That means mortgage bankers made less money. But do you want to know who still made money? Home sellers who were still able to sell their homes for top dollar. Now here we are today, still in the early parts of 2024, and you have a lot of people very confused and concerned about what's coming in the housing market this year because, well, 2023 created this huge slowdown in the housing market, but prices didn't really go down. In fact, prices still went up in a lot of neighborhoods, and this is where a lot of people are wondering if they're going to see any relief in the housing market because a lot of people have been wanting to buy a home, but they've been sitting on the sidelines, seeing housing become less and less affordable. I'll show you. In 2019, just 5 years ago, the median price for a home sold was $269,000. So now if you wanted to go out and buy this home for $269,000, let's just assume that you put 20% down, you finance the other 80%, getting a mortgage in 2019, well, that meant you could go out and get a 4.15% 30-year mortgage. So now, if you were to get this mortgage, your monthly payments would be right around $1,050 a month for the median home that was being sold in 2019. Now let's fast forward to what the housing market looked like for home buyers in 2023. As of 2023 and the early parts of 2024, the median price of a home sold in America is now $412,000. Assuming you put down a 20% down payment, you're going to need a lot more money today, almost twice as much money today. But if you put down the 20% down payment, now you're going to have to get around a 7% mortgage, not the 4 and some change mortgage that you can get back in 2019, which means that now your monthly payment has grown to right around $2,200 a month as of 2023 and the early parts of 2024. That means not only is the median home selling for more than 50% more dollars than what it was just 5 years ago, but your monthly payments on that same median home are more than 100% more than what they were just 5 years ago, because not only do you need more dollars, but you have to pay higher interest rates to borrow those dollars. Now, unless your income has doubled in the last 5 years, you can start to see why more and more buyers are kind of sitting on the sidelines wondering if they're going to get any break in the housing market. And this is where there's a lot of uncertainty as to what's going to be coming in the housing market. So let's talk about what's going on with home prices and what's influencing home prices. Now, of course, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter that my team at Briefs Media created. At Market Briefs, you get a free newsletter Monday through Friday and Sunday, where my team is breaking down what's happening in things like the housing market, the stock market, the global economy, our own economy, and the crypto market into a fun, witty, and easy to read newsletter. It's completely free. You can read it in less than 5 minutes every morning, and I promise you're going to love it. And if you don't, well, you can always unsubscribe at any time because it's completely free. So if you'd like to join Market Briefs and stay up to date, I got the link to how you can join down in the description below, or you can go to briefs.co/market if you'd like to join. At the end of the day, the thing that determines housing prices is supply versus demand. When you have more buyers than sellers, more demand than supply, this pushes home prices up because the buyers are fighting against each other to buy the limited amount of homes available for sale. When you have more sellers than buyers, more supply than demand, now the sellers are competing against each other to get one of the limited buyers to buy one of their homes. So when the sellers are competing against each other, they're competing by price, and means they're cutting their prices to get one of the buyers to buy their homes. Today, in 2024, it's not a surprise, but we are in a seller's market. That means that you have more buyers than sellers that are interested to buy a home. But what you also have to remember is that no housing market stays in the same place forever. Today in 2024, we are in a seller's market, meaning sellers have the upper hand. But if we move back about 10 years, then we were in a buyer's market. Between 2008 till 2012, 2013, we were in a buyer's market. That was where buyers had the upper hand because there was a lot of sellers selling their homes, but not that many people were buying. And if you go back even more, around the 2002 to 2005 time, well, that was a seller's market again, because that was when you had a lot of buyers who wanted to buy homes, but not that many sellers that had homes that they wanted to sell. So you got to understand that housing is also cyclical. Sometimes you have sellers markets, sometimes you have buyers market. Today in 2024, we are in a seller's market, and to understand the shifts in the markets, you have to pay attention to supply and demand. Now, let's start by taking a look at demand because this is a little bit easier to understand. Starting with the interest rate side. Interest rates play a big factor in demand because when interest rates fall, that helps push demand higher. And this one we saw pretty clearly during the pandemic, because when mortgage rates fell in 2020 and 2021, we saw this huge boom of demand, huge boom of people wanting to buy a home because everybody wanted to take advantage of the 2.5% or 3% or 3.5% mortgage rates. And this created this huge surge of buyers, a huge surge of demand. Now, the big question a lot of people have is, are we going to see interest rates get cut in 2024? And if so, how aggressively? And this is where there's a lot of uncertainty. The Federal Reserve Bank has said that they want to cut interest rates in 2024, but they haven't really made it clear to what extent they want to cut interest rates and when they want to do that. As of what we know today, the Federal Reserve Bank says they want to keep interest rates higher for longer, but what does that exactly mean? We don't know. If the Federal Reserve Bank starts cutting interest rates, then you have to think that that could potentially boost demand, because if mortgage rates fall, you have some buyers sitting on the sidelines waiting for mortgage rates to fall to 6% or 5%. And if that were to happen, they'd be willing to go out and pay more dollars to buy a home because they can get a cheaper mortgage rate. And so people would be willing to pay a higher price for a home, assuming they can get a lower mortgage rate. I'm not saying that's the right thing to do. I'm just telling you what people are willing to do, because we have seen this happen. So there's kind of that uncertainty as to what the Federal Reserve Bank is going to do and what's going to happen on the demand side. But in addition to that, the second part of demand is really just what's happening in the economy. Because when you have a strong economy, well, people are more likely to go out and buy homes. When you have stocks rising, when you have asset prices rising, people are more likely to buy homes because they're excited. But when people are worried about the economy, if you're more worried about job losses, if you're more worried about an economic slowdown, people get more scared and they don't want to make a big financial purchase like buying a home. Now, there's a lot of talks about the economy slowing down in 2024, but we haven't really seen that big slowdown happen yet. And until we see a jump in unemployment, and until we see a big slowdown in the economy, well, that demand is still probably going to be there. And if interest rates fall while the economy is strong, well, you bet the demand would continue to rise after that. This then brings us to the supply side of the housing market. And what we've been seeing even now in 2024 is that inventory is still extremely low. There are not that many homes available for sale, which means that even though demand has fallen because of the higher mortgage rates, the low supply has created this low supply and low demand market where even though you have low demand, it's higher than the supply, where home prices can continue to stay elevated and potentially even move higher in many neighborhoods. And so the question is now, when will supply increase? And if you read any of the economic reports, many reports say that it will take time for inventory to recover. Yes, inventory is expected to rise a little bit in 2024, but it's expected to take years for inventory to fully start to increase. Now, what could impact inventory are things like foreclosures hitting the market. Because, well, if people are facing a tough economy, they can't make their mortgages, and then they start to get foreclosed on, that could create an increase in supply, but we haven't seen that happen yet. And you might have heard of people talking about foreclosures rising because all these numbers say foreclosures are rising. However, what you have to remember is that these rising foreclosure numbers that you're seeing in the news are relative to where we were just a couple of years ago when there were no foreclosures. Relative to where we were pre-pandemic, foreclosures are still extremely low. And this is where now you have to pay attention to what's going on in the economy, because if the economy starts to go down even more, that could create more foreclosure issues, which could help the supply side, but that is a long process. If foreclosure doesn't happen in 2 months, it can take months to a year plus for that to happen. Not to mention the inventory is also going to take time to increase. So in 2024, don't expect a huge shock on the supply side of homes, but demand can be more easily influenced by interest rates, and if interest rates get cut at a time that the economy is still strong, that could create even higher demand for the housing market. Now, of course, all this can flip tomorrow if you start to see a major change in the economy, because economic changes can impact the demand and it can impact the supply side of homes. So that's why, you can't really predict what's going to happen in the housing market tomorrow, but you have to pay attention to the different factors that are at play, because it's like a moving jigsaw puzzle. We have all these different things happening. And this is why today what you're seeing is that it's become so much more affordable for many people to just continue renting their home as opposed to buying their home. But the thing that I want you to remember isn't that it's better to own or it's better to rent. The thing that I want you to remember is that it's better to afford where you live. Whether you're buying or whether you're renting, it's better to afford where you live. And what that means is you can make the monthly payments and continue to invest your money into other assets. Things like stocks, things like going out and buying other rental properties or your own business. The key is that you're not spending all of your money on your housing, whether you're renting or whether you're buying, that we have more money to invest, because the way you become wealthy isn't by just paying down your home, it's by owning more of these assets. stocks, real estate, and businesses. So whatever you do, whether it's home ownership, whether it's home renting, I don't have anything against home ownership. In fact, it's very nice to own a home and pay it off that we don't have to worry about the mortgage payments. But you want to make sure that when you're thinking about buying a home, you're not stretching yourself so thin that you no longer have money to keep investing your money, because real wealth is built through your investments, not through the home that you live in. So no matter what you're doing, just make sure you're making a financially educated decision and not an emotional decision. And with that, I'll see you tomorrow. We have the most resilient and strongest economy in the world. And that's going to require you to have the most discipline, because those booms and busts can create opportunities for you to purchase some investments at a discounted price. But for most people, 98% of America, the way that you make money is not by trying to time the market. It's just by putting your money into the markets,